global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves and then they wake up to reality and they, crash, correct down. So there's a little bit of that going on. But in terms of the global economy, I think your use of the word global is very much on point because we are going into or may already be in a global recession. Now that's rare. It's rare when China, Japan, US, Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal. For obvious reasons, because, it affects basically everyone, but, there's no life preserver. There's no, it's not like China's going to pull us all out of it with cheap exports or Japan's going to, put the pedal to the metal in terms of fixed, asset investment, et cetera. So that's a really bad sign. I mean, and just to be very specific, we just saw U.S. fourth quarter GDP grew at a 2.9% annualized rate. People are like, yeah, that's pretty good. And it's not good by post 1980 standards. It's not good at all by post World War II standards, but post 2008, yeah, that's not bad. Again, you have to disaggregate it and you look at what grew. It was inventories were a big contributor, and net exports were a big contributor, and fixed asset investment in particular. There was a big load of aircraft orders for Boeing, which is notoriously lumpy. They'll have a big month, blowout month, and then nothing for a couple of months, not nothing, but something very low. So when you look at that, inventories are counted as part of GDP, of course, but it's not necessarily a good thing. If inventories are piling up, it means retailers are not buying. And this kind of goes back to the whole supply chain breakdown of a year ago. That's what my book Sold Out was about. So you go back to, let's say the spring of 2022. The supply chain had completely fallen apart. And if you were a purchasing manager and you were saying to yourself, okay, we're kind of coming out of COVID, we're going to start growing, but the supply chain is broken. So instead of ordering one, container, I'm going to order 3 containers because maybe one will get through, through the bottlenecks. I only want one, but I'm going to order 3 and hope for the best. What happened was a lot of the stuff was alleviated, not for good reasons, not really for logistical reasons, but because the consumer slowed down a lot beginning in June, partly in reaction to the Fed starting to hike rates in March of 2022. And then here come the 3 containers. So at the exact moment when demand destruction is kicking in, your inventory is going to the rafters. So what do retailers do, or wholesalers for that matter, but retailers, they slash prices, that 2-for-1 sales, because inventories are a nightmare for retailers for obvious reasons. Number one, you have to finance them, so they eat up working capital. It could be cash, but now you got a bunch of stuff in the back office. And number two, it just takes up space. I mean, insurance costs and other costs like that. But the other thing people kind of underestimate is that, like, fashion stuff goes out of fashion. Last spring's styles are not next spring's styles. You still got last spring stuff. Good luck. We're getting close to spring, so you're dumping that stuff. Consumer electronics, you got an iPhone 13. Well, everybody wants an iPhone 14, whatever. I mean, you take the point. So piling up inventories is a very unhealthy sign. It means the retail sector is drying up, demand destruction is kicking in, costs are going up because you got to finance all this stuff, and your profit margins are going down. So I don't take a lot of comfort from that. But the other thing, to the extent you can disaggregate monthly data, and there's a lot of monthly data, 2.9% annualized for the quarter, but it really slowed down in December. Christmas was a disaster. I mean, people bought stuff for Christmas, but way below expectations. And again, it goes back to piling up the inventory at the worst possible time. So it looks like the U.S. is going into 2023. Possibly recession started in December. If not, we expect it to start soon. But you're seeing the same thing in Europe now. Europe got a break with the weather. Obviously there's a war going on, so that's a big factor. But, and natural gas prices skyrocketed and oil prices skyrocketed again in mid 2022. They've come down, but it doesn't mean that, all is well or they're out of the woods. And there are other things going on. China is a basket case. They went from zero COVID. It was bad public policy and bad health policy, but they did it anyway. So they flipped almost on a dime. So they just turned on a dime and said, okay, let it rip. The policy, let it rip. Okay, let everyone get infected and we'll do the best we can. One of the ways you get through it is by letting it rip, and you develop what's called herd immunity. And that's what worked in North America and Europe. But the other difference between China and Europe and the US is that they don't have the healthcare system to deal with it. Our healthcare system, which is pretty good, was strained. Same thing in Europe. China has nowhere near the ICU units, the oxygen, the treatments, the professionals, the nurses and doctors, not even close. And when you get out to the village level, which is where most of the people still live, believe it or not, they often have nothing. But that is hurting the economy as much as the zero COVID. They had no good ways out. I'm not saying one's better than the other. They're both awful, but you still have a lot of things that are not COVID. The real estate collapse, the excessive debt, the demographic decline, just the impact of top-down management when you can't possibly get everything right, and decoupling from the U.S. and the U.S. cutting off, high-tech exports to China, including third country exports where they're relying on U.S. licenses or equipment. So China's in a deep hole, probably in a recession. Japan, same thing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then, there's what I call the reality. And I guess I'm a storyteller here, but, what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay. They're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They probably are at the, so-called terminal rate. They just don't know it. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot, to say that there could be a rate cut. It won't be in April, but, rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow. So maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about this. He was on the short list to be nominated to the Board of Governors in Washington to fill the seat that Lael Brainerd left. Lael Brainerd was a member of the Board of Governors. I believe she was vice chairman, but she left to go to the White House in the National Economic Council. She really is smart. She's a big brain. She knows what she's talking about. Very few of them do, but she's one of them. But she goes to the White House, but that's an audition for Secretary of the Treasury because they're going to throw Yellen under the bus. Yellen knows nothing. If Yellen were on this call right now, she wouldn't know anything we're talking about.
How is that possible, Jim?
Affirmative action. When she was chairman of the Fed, I said she was incompetent, and I was right. And then she became Secretary of the Treasury. She's a statistics geek from Berkeley. She's got a big brain. I'll give her credit on IQ points. So what? That's not the same as common sense or working knowledge or knowing how the street works. She's never worked, outside of government in her entire life. I don't care what your resume is. If you've never run a business, met a payroll, negotiated a purchase sale agreement, kept your morale up with negative cash flow. If you've never done any of those things, you don't know what it's like to be in the real world of the economy. She doesn't, but her specialty as an economist was labor economics. Okay, well, there's a place for that, but not as U.S. Treasury Secretary. You have to know she didn't know monetary policy of the Fed. She doesn't know fiscal policy of the Treasury. Knows nothing about international economics, and that gets us into the role of the dollar. She was like her husband won a Nobel Prize. Okay, George Akerlof. I know a lot of her close associates. If you don't want to say affirmative action, you can say the Peter Principle. Which, this goes back to the 60s, but the Peter Principle is you get in a bureaucracy and you do a good job and they give you a promotion. And then you keep doing a good job and they give you another promotion. And you keep doing a good job. And eventually you get promoted to something where you're incompetent. You're in over your head and you fail, but then you stay there because you're not getting another promotion. And so the result is bureaucracies are populated with incompetent people because they've all risen to their level of incompetence and have nowhere else to go. I would say she got there at the Fed, how she got another chance at Treasury, but that's the answer. But Lael Brainerd, I'll say, is more talented, and hopefully she'll be. So they'll throw Yellen under the bus, blame her. By the way, that's the Biden technique: deflection and denial and just blaming other people. So they'll blame her for the whole thing. She probably doesn't see that coming, by the way. Maybe she should tune into London Real. And then they'll put Lael Brainerd over there. But Mary Daly was on the short list to fill Brainerd's seat at the Fed. Well, you can forget that she can't get the hearing at this point. But she was running around on, climate change, social justice, George Floyd, BLM. And again, free country, you want to express a view, be my guest, but not as chief regulator of Silicon Valley Bank. Yeah.
It's so should they have let it fail? And what would have been the carnage, Jim, if they had?
Well, again, this is hindsight. You shouldn't have been allowed to get to that place anyway, but there might have been more. This is where there's a lack of creativity. It's kind of all or nothing. It's like, if this fails, we're going to have a wave of failures of startups in Silicon Valley. Well, that's probably true. But most of them fail anyway. If you know the venture capital business, and I'm sure you do, most of these things fail anyway. A couple of winners here and there. Well, how difficult would it have been? So now you're the entrepreneur. You had $5 million of working capital, which you got in a round, an angel round or whatever from some venture capitalists in Silicon Valley. You got some premises, you got a payroll, you got some developers, you got employees, all that stuff. And now your cash is frozen. Not just frozen, but gone. You got a Yang money, you got a due bill from the FDIC. Who's to say if those companies were well run and they actually had some good technology, how difficult would it have been to make a few phone calls and say, you know what, we're stuck in this thing. I need a 2-year bridge loan, or I need a 1-year bridge loan. And I'll collateralize it by the proceeds of my receivership certificate. And as and when I get paid, I'll pay down the loan. We can have a simultaneous closing. All good. You could have got money. Some of those firms could have got money. Some of them not. Maybe some layoffs. Maybe they would have failed, but most of them do anyway. I mean, that's my first point. But that was not the majority of, and unemployment would have gone up. I mean, I'm not saying that there are no hardships, Brian, but we gloss over the greater hardships on the economy as a whole. And that gets to the other lie, which was Janet Yellen coming out and saying, there's no cost to the taxpayer. Like, wait a second. Because you mentioned the bailout of the Fed taking the loans below market value and giving them, at market value and giving them par value, which is more for 1 year, and glossed over that whole thing. But there was a separate bailout, which is the FDIC guaranteed every penny of every deposit in all those banks. Well, when you look at the numbers, you have grossly depleted the insurance fund. The FDIC is an insurance company. That's what the I stands for. And they have reserves, just like every other insurance company. They charge premiums. That's how they go. This would have basically wiped out the reserves. So how are you going to top up the reserves in the FDIC for future bank failures? Well, they said, we're going to raise premiums on the banks. Okay, they are. But what do the banks do? Well, they're going to either pay you less interest or charge you fees. In other words, the bank isn't just going to sit there and write checks to the FDIC and watch their P&L evaporate. They're going to pass the cost on to the customer, which is us, which is the American people. So does your tax bill go up? No, but your interest rate's gone down or your banking fees are going up. So the cost is shifted to everyday Americans. So don't tell me that we're not paying the bill, because we are. So again, these are in the nature of government lies to kind of, disguise what they're actually doing. Well, I don't have $100 billion, so maybe there's a level where you got enough money and it's not your primary concern. I like making money, but it's not what the first thing I think about when I wake up in the morning. The first thing I think about is how do you solve problems and what's going on. Musk seems to have some of that, maybe more than a little. Look, if you don't have free speech and you abandon the Constitution, I mean, is this like the fall of the Roman Republic? I mean, there's a little bit of a uncomfortable resemblance. Again, going back to what we said earlier, you got to study history. It's certainly not the same, but there's no better playbook for doing analysis than a really good understanding of history. It's why today in America, and I would say not just communists, but neo-fascists and other forms of dictators, and we have plenty of those in Washington. One of the first things they kill in the curriculum is history. They stop teaching it, because if you knew a lot of history, you'd see these things for what they are. But I had some pretty good history teachers, and I've always been interested in it. So yeah, I was shocked by what's revealed, even though I've been around enough to maybe not be shocked, but just the extent of it and the depth of it. And I have a lot of sympathy for the users who were suppressed and squashed and deplatformed, and even more sympathy for the victims of that kind of censorship.
So we were on the front lines of that information war in 2020. And so when I see these files, I see it from a slightly different angle. I mean, April 6, 2020, we had the second largest YouTube live stream in the world that day, Jim. 65,000 concurrent viewers watch me in this studio have a 2.5-hour conversation where things were questioned as far as efficacy of a PCR test, masks, future vaccination policies, which were really early. Even origination of the virus might have come out of Wuhan, something they'd literally almost lock you up if you had mentioned that in April of 2020. 30 minutes after that, Jim, for the first time in my 9-year history of London Real, a video of mine on YouTube was deleted and banned. And I thought, what is going on here? I thought the weirdos are the people that got censored in this world. And then after that, I was subsequently shadow banned from the following platforms: LinkedIn, Facebook, Instagram, Dropbox, PayPal, right? With 6 figures of balances on PayPal. Dropbox, where I didn't think they were watching my videos. I mean, that's technically my information. And again, I'm not a conspiracy theorist. I leave that to the guests on my show that come on, because I think they have the right for free speech and we should all listen to what they have to say. But when I saw those Twitter files for the first time, Jim, I thought, okay, if there was a coordinated effort, it would have to come from a single source. And why not come from someone who's trying to say, please, can we stop people talking about X? So I saw it in a slightly different way, to where I was like, oh, okay, now I could see maybe how that coordination could happen.
And I like the way you put it, Brian. You said with this guest, this particular show, you were questioning things. You weren't being categorical about this. You say, well, maybe it did come from Wuhan. And that's what you're supposed to do. My book, the New Great Depression, came out in January 2021. Interestingly, the publication date was delayed because of the supply chain, which was my next book. But I had it pretty much done by the summer 2020. And what strikes me was the evidence was there then. Now, 2 years later, you're watching whatever, Tucker Carlson or, Alex Berenson or others. I'm sure there are many in the UK. And they're saying, do you know that the masks don't work and the lockdowns don't work? And this thing looks like it came from Wuhan. I was like, yeah, I do. And I said that in 2020, but the point is the evidence was there. It wasn't guesswork. I'll give you a real quick example. The leading epidemiologist for virologists of the 20th century, maybe all time, is Dr. D.A. Henderson. Now, D.A. Henderson's not a household name, but if there's a single individual most responsible for eradicating smallpox on the planet Earth, It was D.A. Henderson. He won the Presidential Medal of Freedom, which is our highest civilian honor, equivalent to the Congressional Medal of Honor in the military, dean of the Bloomberg Johns Hopkins School of Public Health. I mean, you can't go any higher in the profession, have more respect than D.A. Henderson. He wrote a paper in 2005 that said lockdowns don't work. And he had the research to back it up. This was at the time, I believe it was the swine flu was going. There was an avian flu and a swine flu during the Bush administration. Bush was actually very concerned about it. And Henderson wrote this paper, said they don't work. And I cited that in my book. But the point is, we didn't have to wait until 2021 or 2022, in China's case, today, to find out that lockdowns don't work. In 2020, we had a paper from 2005 that said the same thing. He said, if you have an island and there's no airstrip and only one way in or out, and you got 100 people, maybe, but that's not North America, that's not Europe, that's not the world. They just don't work. Well, if we knew that from the leading epidemiologist, maybe of all time, why didn't we follow that advice? Well, the answer was it was a hidden agenda. They wanted to shut people down. They wanted to basically we empowered the inner fascists in all these government bureaucrats. I mean, it was Black Scholes, it was Fisher Black, Myron Scholes, but there was a third contributor, and he won the Nobel Prize, which was Robert C. Merton. Merton was at Harvard, and Fisher and Myron had worked on this for a long time and had come close, but weren't all the way there. They went to Merton to help with the math, actually. And Merton solved the math problem for them, but to his credit, and very generous, and another really nice guy, he said, look, you guys go ahead and publish this, and then I'll tag along a few months later with my contribution. And the Nobel Prize is not awarded posthumously. So Fisher Black sadly died before they got the prize. So Merton and Scholes won the prize. And again, to their credit, they pooled the award, divided by 3, and gave 1/3 to Fisher's widow, which I thought was very, appropriate and, very generous of them. But, it was a math problem. You write about what they call Brownian motion, which is random. And, so it was sort of, you had a fan, if you will, of probabilities. And then, different degree distributions, some more likely than others, et cetera. Having said that, and the success of Myron used to say, Jim, if only I had patented the idea and had like a fraction of a penny on all the notional value, I'd be the richest man in the world, which is probably true. Yeah. But they didn't. They put it in an academic journal. But there are assumptions in Black Scholes which you can question. I'm not dinging the model. Science is always, hey, let's make it better. It doesn't mean you don't use what you have. But they assume a risk-free rate. Well, is there really anything, is there a risk-free rate? Is the United States risk-free? I don't think so, actually, and it's getting riskier by the day. So you can kind of question that assumption. Does the future resemble the past with some probability, some degree of distribution probability? Not always. I mean, and maybe less frequently now than ever. And they also assume that prices move continuously. Prices go up and down, of course, but that you could get, if it were going up, you could get out of certain levels. If it were going down, you could put stop losses on your position and get out of certain levels. You could manage it. And of course, that was a big contributor to the 1987, October 19th, 1987 flash crash, when the market fell 22% in one day. I mean, today we get worked up if it's down 22% in a year, which it was last year, approximately. But this is 22% in one day. But it turns out none of that's true. Markets don't move continuously, or if they do, it's when you don't care. When you do care, they just gap. They gap down or they gap up. You miss it, you blink, and it's at a completely different level. It's been repriced. Now, you can still get in and out, but you've either made a lot of money or lost a lot of money, in the blink of an eye. So when you take those characteristics, and this is how I started kind of, deconstructing it, if you will, and say, well, look, markets are not efficient. That's nonsense. They don't move continuously and slowly. They gap up and they gap down. And if you're not ready for that, you've missed the boat. Nothing's risk-free. So why don't we start there? When I started identifying those factors that, in my view, were incorrectly applied in long-term capital, but really everywhere, And you say, well, what looks like that? Well, the answer is a complex dynamic system. You know, a system that produces hurricanes and tornadoes and lightning bolts and power outages and earthquakes and tsunamis. Those are all examples of the results of complex dynamic systems. An earthquake doesn't sneak up on you. It just the ground falls out from under you instantly. And that's what happens in markets. So then I said, well, maybe that's a better model. Of course, it is. So, very good point, Brian. So let's go back to either Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. And I talked to a guy. I know no reason to mention names, but runs one of the largest endowments in the world. And he said, Jim, we moved. We were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We didn't end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. One of the big crypto promoters, they forget the name. Well, the particular name of the bank, but they back one of the stable coins. Actually, it's USDC. Yeah. Had $3 billion in Silicon Valley Bank, and they talked about all these small entrepreneurs and startups. They got 100 employees and $5 million in working capital, and that money's gone, and they're all going to fail. There was something to that, but the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. In the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank. And they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured, no worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So, and that was it. Well, that's when I call the billionaire crybabies came out in force. Bill Ackman, all these guys. Oh, you got to save us. I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people. So almost nobody knew at the time except the management, although they seemed to be asleep at the switch. Everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits of Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much as is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses, and by the way, we are in an election cycle here in the United States, but from the greenies, who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night at 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. So let's go back to Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. I talked to a guy, no reason to mention names, but runs one of the largest endowments in the world, and he said, Jim, we moved, we were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We didn't end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. One of the big crypto promoters, they forget the name. Well, the particular name of the bank, but they backed one of the stable coins. Actually, it's USDC. Had $3 billion in Silicon Valley Bank, and they talked about all these small entrepreneurs and startups. They got 100 employees and $5 million in working capital, and that money's gone, and they're all going to fail. There was something to that, but the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. In the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money up, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank, and they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured, no worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So, and that was it. Well, that's when I call the billionaire crybabies came out and forced, Bill Ackman, all these guys. Oh, you got to save us, I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people. So almost nobody knew at the time except the management, although they seemed to be asleep at the switch. Everyone's like, yeah, startups, venture capital. And there's a lot of truth to that. 97% of the deposits of Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's the way, if you're looking at these big banks or any institution or your own savings institution to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years. But they're working on it. Wind turbines. Other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much as is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses. And by the way, we are in an election cycle here in the United States, but from the greenies who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night at 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. The math and the science behind diversification and why it's a good strategy is very clear. That's not much debate about that. The problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks. And in stressful situations, they become highly correlated. So you're not getting the benefit of diversification. You think you are, but you're not. So what does a diversified portfolio look like? Well, I have a slice of stocks. I'm not anti-stock market, but you got to pick the sectors and the stocks that will perform well, even in the kind of conditions we're talking about. And I would go back to energy, natural resources, agriculture. So, a Marathon, ExxonMobil, Chevron, ADM, Cargill, mining companies, and not just gold, but I recently invested in a lithium mine. The Green New Deal, I call it the Green New Scam. It's a scam, but it doesn't mean it doesn't have legs, whether you like it or not. The fact is, it's going to go on. So the lithium's in short supply, graphite, et cetera. So there is a portfolio you can have, which is natural resource oriented, that will do well, even in the kind of tough environment we're talking about. Slug of cash, absolutely, maybe as much as 30%. I like treasury notes, 10-year treasury notes, but seasoned to taste. If they're a little too volatile, look at 5-year notes, 2-year notes. They're going to come down a lot, not right away, not tomorrow morning, but sooner than later, because of everything we discussed, which is recession and interest rates will follow. They're a lagging indicator, but that'll happen.
Bonds, particularly the sovereign bonds, especially the U.S. Treasuries, they're looking the best they've seen in a long while, and relatively recently, some have said it's like the best I've seen in my career. So I'm just curious, do you find that compelling for the moment in time we're in here?
Absolutely. There's hate to get too deep in the weeds in terms of bond math, but there's something called a DV01. DV01 is the dollar value of 1 basis point. What that means is, obviously, basic bond math, interest rates come down, the price of the bond goes up. They're just inverted. It's a little counterintuitive, but the question is how much. And the lower the interest rate, the more the price of the bond goes up for every basis point drop in rates. So in other words, if you go from 9% to 8%, you'll have a nice capital gain on your bond. But if you go from 3% to 2%, it's still a 1% drop, but you're going to have a much bigger capital gain. In each instance, it's a 1% drop in rates, but the amount of capital gain on the bond is much higher. As the DV01 is higher when the rates are lower. Again, it's all counterintuitive. The lower the rate, the greater the capital gain on each basis point drop in yields. That's the basically. So yeah, when you go from 3% to 2%, that's a home run in terms of capital gains. So you get the yield, you get the safety, you get the liquidity, and if you feel like selling it, you got a nice fat capital gain. Gold, I always recommend 10% slice. But based on what we were talking about, I would get silver dollars, American silver eagles. The monster box, that's a bit of jargon. Monster box comes from the U.S. Mint. It's treasury green, nice shade of green. It comes with a compression strap. I recommend don't open it, unless do not break except in case of fire. But inside are 500 1-ounce American silver eagles. That's a lot. They'll feed your family for probably a year. It's a market price, be around $10,000, $12,000 for a monster box. But to me, it's like battery and flashlight. I like them both. And, I talk about gold a lot because it's a form of money, and I do the monetary analysis. I do invest in gold mines, but I don't hold myself out as a geologist, but I do think about it from a monetary perspective. And then people always say, Jim, what about silver? What about silver? I'm like, look, if gold soars the way I expect, silver's along for the ride. There's not going to be a world of $3,000 gold and $20 silver. That world doesn't exist. If gold's at 3,000, silver's going to be pushing 100. So without giving an exact forecast, silver will be along for the ride. Silver is a little more difficult to analyze because it has industrial applications. Gold really doesn't. Gold's not good for anything except money, but it's the best form of money. Silver is used in a lot of applications. So if you have a recession, it's perhaps the case that the monetary value is going up, but the industrial input value is going down. So it's a little bit more of a mixed bag, but silver is going to do fine. And I do think it's extremely practical because in a world of CBDCs, silver will be a form of spending money. Gold, even the 8-gram coin I mentioned, the 1/4 ounce American Gold Eagle, still $500. It's like pulling a $500 bill out of your wallet. It's a lot for groceries. Home prices are coming down a little more in some markets than others, but if it's income producing and it's solid and it's a place like, someplace people want to be, like Austin or Phoenix or whatever. I know there's markets down a little bit right now, but it's like buying a 10-year bond. It's got steady monthly income and or certainly farmland. But income producing real estate, not commercial office buildings, should be a part of a diversified portfolio. Yes. I like private equity, and it's, you got accredited investor issues and finding good deals and good promoters and good management. But, some good deals in the mining sector I like. Well, that would be one.
I wanted to talk to you real quickly about the current state of media. I'd just love to hear your thoughts on this because I know this is something that you care about, that you've written about a bit. And you're playing a role in trying to give people, more accurate, more nutritious, more actionable information than what they're able to get from the news sources that they're just directed to by society.
If you talk about what they call legacy media, mainstream media, so Washington Post, New York Times, LA Times, NBC, ABC, CBS, MSNBC, right, CNN, that run of characters, the first thing you discover is, I know a lot of these people. I've been on all these programs. I know this for a long time. I spent a lot of time in Washington, had dinner with most of or lunch or whatever, dinner actually more often with most of the names you've heard about. Some of them are fine, some of them nice. A lot of them are either not that bright, Or, I mean, they're good on camera, or whatever. They got a desk at the Washington Post. They're not that bright. Or if they've got some degrees, they've been kind of indoctrinated. We're at the point now. I mean, a lot of these people are 28, 33, 34 years old. There's nothing wrong with that. That's, good. You're in the heart of your career. But that means they graduated from school in, 2016, 2017, or whatever. And they're thoroughly indoctrinated. I mean, I went to school when we learned, it was pretty rigorous. I mean, I had one program where they graded, you needed a C+ average to graduate, but they graded on a C- curve. So you're like, how do you get it? How do you even get a C+ if they're grading on a C- curve? The answer is people quit. In other words, you were trying to struggle to be. I did get an A in partnership taxation. And I'm proud of that. But the standards are down. The mission standards are down. Affirmative action takes over. When you get into the classroom, I don't care where you're at, Ivy League, whatever. It's just indoctrination. The market has a way of sorting it out. I mean, if revenues are down, advertising's down, viewers are down, subscriptions are down. Eventually, they will go out of business, not overnight, and then new media channels will arise. And there's a lot of garbage on the internet, but there's a lot of good stuff. And if you want to keep tabs on the war in Ukraine, you have to know where to look. It's not easy, but there are a number of channels with, and I'm talking about, military officers, colonels, brigadier generals, people on the ground in Ukraine, not, some studio in New York. You can find out what's going on, but I think my intelligence training is helpful because you have to be very persistent and know how to dig. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse, yes. But this really started with Trump's trade war in 2018. That, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, I talk about China, Ukraine, supply chain, Biden, they're all a big deal. In terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. The number one question, because everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. One of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50, and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it. So the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. And there's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. And, there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the real The market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets on the back of a recession.
I'm not alone. I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So, I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20, 30%?
Yes. And again, you have to remind people, 1929, everyone's like, October, I think 18th or 19th, it was late October 1929, the stock market fell 22% in 2 days. It wasn't one day. It was, it was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So, we're down, NASDAQ's down, bounced back a little bit in recent days, down close to 30%, down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because, I was looking at some of the inflation numbers and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But, how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
That's exactly right, Brian. And if you're a little younger than I am, but I lived through it. I started my career in banking in 1976. And I remember my wife and I used to kid each other. She was in advertising, I was in banking. And the inflation was so bad, you'd get a raise every 4 or 5 months. And you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise and she was making more than I was at the time. So we'd go out to dinner and I would get a raise and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41, actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning. You say, that's some inflation. Yeah, we did. But it had started. In some ways, it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power. Not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was, 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. Again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s, and I'll explain why. In the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war. And then the price tripled, but it went from like $2 to $6. Okay. Well, percentage terms, that's a huge jump, but it was still $6. And then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where, supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or, kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described. And as I said, I lived through the 70s, where, hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food, you got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially. And the two things you can't do without, we got through 1998, we got through the dot-com crash, we got through 2008, we got through 2020 and COVID. There's actually a good size market drawdown in 2018 between October 1st, 2018 and Christmas Eve, what I call the Christmas Eve massacre. Stock markets dropped 20% in under 3 months when the Fed kept raising interest rates, even though the economy was weakening. So they have seen those, but every single time it came back, even in COVID, March, April 2020, the stock market went down 30%. It did. Just almost straight down. But by September, we were back to new all-time highs. And so it's not that they've never seen that kind of volatility, but they learned the wrong lesson, which is it always comes back. And we know why, because the Fed bails you out. The Fed floods the zone with money. The Fed talks it up, et cetera. But the counterexample in 1929, when the stock market did crash, it was down 23% over 2 days. It was like a 12% day and an 11% day in late October 1929. But it kept going. The stock market crashed in October 1929, but it bottomed in June 1932. That was a 3-year moving crash or rolling crash, whatever you want to call it, with some rallies along the way. And the total damage was over 80%, not 30%, not 40%, down 80%. And what people don't know, many people don't know, is you said, okay, then it rallied in 1933 and 1934. The Fed messed up again and blundered again, as they usually do in 1937, and threw us into a double dip. But if you ask people, okay, well, everyone knows the stock market crashed in 1929. When did it regain those highs? How long did that take? The answer is 25 years. It was 1954 before the market recovered from 1929. Now, it doesn't mean there weren't gains along the way or you couldn't make money. You could. But if you say, oh, I'll just sit tight and wait till it comes back, well, a lot of people didn't live long enough. They never saw their money back because they didn't live 25 more years. So that's a real bear market. It's happened before. The point is you need to be prepared for things like that. And there are no one alive, but very few people alive have seen anything like that. And if you say, well, what if we had another market crash right now? We'll talk about reasons why in a second. Why couldn't the Fed just come right back in and, print some more money and do the same thing over again and bail out the new failures, whoever they may be? You can just kind of keep bailing things out. Why not do it again? What's the big deal? Well, the answer is each bailout is bigger than the one before. And that's the point. You can go all the way back 1994, Mexico, 1998, Russia, LTCM, 2000, dot-com, 2008, Lehman, 2020, pandemic. And they do bail out, but each one's bigger than the one before. I mean, we threw out $6 or $7 trillion of new debt on top of a $1 trillion a year baseline, $7 trillion in new debt to kind of dig our way out of 2020. So there's a limit. There comes a time when it's like, hey, this bailout is going to be 20 trillion, sorry, that check's too big. We're going to have to let some things fail. So what could happen? The first thing on my list is we're heading for a very severe recession. I just want to kind of explain briefly the dynamics of that. So the Fed's raising interest rates. We know that they started, it wasn't that long ago, but March 1st, 2022, the Fed policy rate was zero. It was 0%. People remember Paul Volcker. Oh, Paul Volcker raised interest rates to 20%. Well, he did, but so far Powell hasn't raised them as high, but he's raised them fast. I mean, even when Volcker was working his way to 20%, it took 3 years from 1979 to 1982. So Powell's plan is clear because he's told us. He said inflation is job one. It's not that we don't care, but unemployment is going to go up. We're going to have a recession. He doesn't use the R word, by the way, but it's implicit in everything he says. We are going to have a recession. Unemployment is going up. And too bad. It's kind of too bad because we got to get inflation under control. And so the Fed is in search of something that they call the terminal rate. What's the terminal rate? The terminal rate is a rate that's high enough to bring inflation down on its own without further hikes. So it doesn't have to be higher than inflation. It has to be high enough to cause inflation to come down to the Fed's goal of 2% without hiking more. And when they get there to that terminal rate, they'll sit tight. They call it the pause. And the pause could be a year. And Powell said this. Again, this is right out of his script. So Powell's in search of the terminal rate. By the way, if you said to me, hey, Jim, what's the terminal rate? I would answer truthfully. I would say, I don't know, but neither does Jay Powell. Jay Powell doesn't know what the terminal rate is. He's kind of saying, we'll know it when we see it, but we're not there yet, and we're going to keep going. And they have what they call the DOTS, silly name, but the members of the Board of Governors and the Federal Reserve Bank presidents give estimates, or their estimates of unemployment, inflation, growth, and interest rates for the next 3 years. And they put them as dots on a chart, so they call it the dots. And then, Wall Street gets the dots. They do a central tendency and regressions and all this stuff. One of the top Fed insiders, like practically sits in Jay Powell's lap and has all the way back to Bernanke and Yellen, told me personally, he said, inside the Fed, they regard the dots as a joke. They're not better than guesses. Their forecasting ability is dismal. You or I would have better forecasts. And they wish they could get out of it, but they don't know how. So that's the truth. But the problem is, Wall Street and the financial media and the talking heads on CNBC, they want to talk about the dots, and it does affect market behavior. So even though it's a joke, even though the forecasts are terrible, you have to pay attention because it affects the markets. And if you're affecting the markets, you're on the wrong side, you're going to get run over. So I look at the dots not because I put weight on them as predictive analytic tools, but because the market pays attention. The market says, hey, inflation is already coming down. And so the market says, hey, you did it. You're already there. Inflation is coming down. Why don't you stop? And by the way, you're going to get the message. The economy is going to be slowing down. Inflation is going to be coming down. And then you're going to cut rates. This is the famous pivot. Whenever you hear of the Fed pivot, that's when the Fed turns around and starts cutting rates instead of raising them. And that'll be just in time, and growth will slow, but it won't be too bad. And we'll come in for a soft landing. And this is the Goldilocks scenario. So again, typical Wall Street, get the pom-poms out, the Fed's going to cut rates, and so buy stocks. That's all Wall Street knows is buy stocks. But the conundrum is inflation coming down because the Fed is still hiking, or is the inflation coming down because they're at the terminal rate? Well, we don't know. It's kind of hard to sort those things out. Powell would say, yeah, it's coming down. I know that, of course, but it's because I'm hiking and I'm going to keep doing it. My view is, no, you actually did it. It's mission accomplished. You just don't know it. That means, as usual, they're going to screw it up. They're going to blunder. They're going to go too far. And it's not going to be a mild recession. It's not going to be Goldilocks. In this version, Goldilocks gets eaten by the bears. In other words, you're going to throw this economy into a very deep recession because you're going to go too far, as usual. And you're not going to know it until too late. By the time you realize it's mission accomplished. You will have gone too far, too long. Rates are going to be too high, and it's not going to be a soft landing. If Wall Street's talking up the stock market based on the soft landing Goldilocks scenario, but Powell's going to stick to his guns and raise rates too high, that's going to cause stocks to crash very severely, very suddenly. If the market were adjusting, say, yeah, Powell means it, he's going to keep it, and we ought to come down a little bit, that would be one thing, but that's not what's happening. The market's trying to rally. Powell's warning people what's going to happen. They're not listening, and it is going to happen. It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no. If you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative for August of 2020, is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, then that weakens the dollar, and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. So going back to the 1920s or earlier, through most of the 19th century. For the United States, in sterling, I think it was $4.75. It could be off a little bit on that, but four pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be, like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank and they gave you paper money. But people did it out of a patriotic, it's existential. War's not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold, but people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System. Bearing in mind, the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets. And the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is that today's market, that 11 billion is actually worth 470 billion. So the Fed has a hidden asset of 450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on two Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it, and everyone pretends it's not money. But of course it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the US, we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a monetary institution. Australia sold most of theirs. Canada sold most of theirs. If I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold an ounce since 1980.